Most people build up one big pension pot and then they get to retirement and they get stung by tax. And it begs the question, should I actually be using a pension and building up this big retirement pot, or should I be using other investment vehicles and products like an ISA? I'm Ryan, I'm a chartered financial advisor, and I help people just like you make better informed decisions. First and foremost, let's get into some basic definitions. When I talk about pensions, I'm specifically referencing your workplace pensions, defined contributions. I'm also specifically referencing self-invested personal pensions. These are pensions you've set up, you've chosen the platform, you've chosen the investment options. When I talk about ISAs in this video, it stands for individual savings account, and I'm talking about two types. I'm talking about your stocks and shares ISA, where you choose the platform and investments, and I'm talking about cash ISAs, which might be with your local bank, where you get a fixed rate of return depending on which platform or which company you go with. When we look at pensions, they're incredibly tax efficient for money going into them. So the money going into your pension, you get tax relief on. So if you're a basic rate taxpayer, that's 20%. If you're a higher rate taxpayer, that's 40%. That's an instant return on your money. And if you're employed, your employer's obligated, like they have to give you money towards your retirement, which is like the only way in the world you actually get free money. It's incredible. The benefit is that tax relief. When you're taking money out of your pension, when you get to retirement age, you're paying income tax on that. So tax relief on the money going in, income tax on the money coming out. And that's where tax optimization is key. Whereas ISAs, there's no tax to pay. You do not get tax relief on the money going into it. So it's taken from your net salary or net income, whatever source that may be, but you don't pay any tax on the money when you access it. But there is no tax to pay on all the appreciation of that investment growth, which is the same trait as within your pension. So within your pension and your ISA, if you're investing, say, £1,000 and it grew to £1 million, you wouldn't pay any tax on that capital gains, that appreciation, which is fantastic. But a lot of people see the ISA as a more tax efficient product because it kind of is, but it isn't because of the benefit from your employer, from your own business, and the tax relief on the money going in. So they're both phenomenal products, which leads people to using a combination of both. Now, this is where it gets complicated. You can take 25% tax-free cash from your pension. Fantastic. Here's a little bit of the rules around that, such as the previous lifetime allowance limit and why the most amount of tax-free cash you can take is £268,000. The thing is that when you start taking income from your pension, if you've got other sources of income, it can push you into a higher rate of tax, and that may not be what you want. So you use your ISAs to supplement that income. So here's an example. You've got your state pension, which is £12,000 a year. You've still got your personal allowance, which is £12,570. So even if you're not working, you still get that personal allowance. A lot of people seem to forget this. You don't have to pay national insurance, which is a win, because you've probably paid it for enough decades to get that state pension. But if you actually need about £40,000 worth of income and then your state pension on top of that, pushing yourself into the upper tax bracket, which can be problematic. So a lot of people will take money from their pension up until they get to that point, and anything above where it starts to get to the higher rate of tax, they'll just take a little bit of income from their ISAs just to optimize their tax situation and not force themselves into that bracket, which is a really good way of optimizing your income for your lifestyle. The way financial planners look at things, we do want to optimize for that, but we also go, your ISAs are incredibly tax efficient. You want to get them as long as possible to compounding growth. So in the later stage of life, you don't pay tax ever again. It's kind of the plan. And that's how we really look at things. Hopefully you found that useful. Thank you for watching my video.